And I'm so glad you brought up inflation, because inflation in the housing market is a very interesting relationship, because the traditional understanding of inflation is what? It's like, oh, inflation, most people think pushes up home values, right? Because it did in the 1970s.
Sure.
That was the big thing. 1970s was a decade of inflation, and the housing market did well during that inflation. But there's another side to it. It's actually not inflation that pushes up home values. It's wages and income that pushes up home values. And so what happened in the 1970s is that, yes, we had crazy inflation, but the wage and the income gains were absurd. It was like 7, 8, 9%, 10% income growth per year. People in the 70s were saving over 10% of their income each year. So actually back then, people had a lot of money. The situation with the inflation today is, yes, we have raging inflation, the worst in 40 years. People, when you back out the government stimulus checks, which artificially inflated the economy, they don't have the same type of savings and money they did in the 70s, actually. And so this is where the inflation today could actually be a big negative for the housing market, because it could just mean like higher gas prices mean people have less money to spend and are going to feel less inclined to want to make a big purchase. And, you know, we have all these headwinds in the economy more broadly right now that are also painting a picture of potentially a recession, which is another topic entirely.
It is. You use the term headwinds a lot. What does that mean? So when our viewers go start to consume your content, which I highly recommend, what do you mean when you say headwinds?
Sure.
How do you define that? What's that?
So I would think of it in terms of the U.S. consumer and the average American household, right? So inflation and higher gas prices is a headwind for the economy. It pushes down on the economy because it's going to reduce consumer spending into the economy. You know, people have 5% wage growth and then a fixed budget kind of on what they can afford to spend. If gas prices double, they're going to have to spend less, which is going to ultimately hurt the economy and hurt the housing market. That's a headwind.
So in the same way, if you got a tailwind coming in from upstate New York to Dallas, you might get here 30 minutes early.
Yeah.
If you're flying into a headwind, you might get here 30 minutes late. Early's always better than late.
That's right.
Same deal. Into a headwind is never a positive.
No, I love you connecting that analogy with the airplane, because it's really good. Into the headwind is just everything's more difficult. You're expending more energy, you're spending more money to get the same or worse results.
Exactly. It's very concerning, especially because, you know, there have been quite a few people who think they've made some good money in real estate over the last 18 to 24, 5 months. Although I don't know what the market looked like around the country, but here I had a couple flips going as COVID reared its planned or fake or real head. Who knows? Anyone who says that they really do know is lying. They really weren't actually making that money, because then they're taking the profits, especially if you're a real estate investor, you're taking those profits and you're going to try to buy new prospective properties. And now those are artificially inflated. They're not actually worth what the demand is saying that they're worth. And so it's fool's gold.
Yeah, I think that's a really good way to put it. And this is not to say that a lot of people haven't made money in real estate. A lot of people have made money in real estate. I would say the ones who made the real money made it before the pandemic, or owned before the pandemic. I think, you know, we had a big surge in real estate investors in 2021 buying. We went from, according to CoreLogic, 800,000 homes purchased by an investor in 2020 to 1.4 million purchased by an investor in 2021. Wow. So you have all these investors kind of coming in at the top of the market, which is meaning that a lot of these investors are going to get burned. And if you kind of look back at the history of investor participation in the housing market, at least institutional, like the big Wall Street banks, it's pretty new. But when the big Wall Street banks initially started getting in, it was at the bottom in 2012 after the last housing crash. After prices had already went down, that's when the smart money investors said, let's buy the foreclosures. No one wants to touch it. Prices are cheap. That's the time to get in. And, you know, more generally, it's also a psychology of investment, right? Like, if everyone is like in a frothy way being like, let's get in, it's always going to go up, you know, that's probably a sign to take it easy. And then now people are seeing the housing markets entered a downturn. There's going to be a point in the next couple of years where the psychology is going to flip. We're going to go through another housing crash, and then all the people today who are saying you got to buy are going to be saying don't buy. But ironically, that's when you do want to buy.